In the shadowy realm where finance meets intrigue, the halls of global banking have played host to a series of gripping sagas, each chapter unveiling the clandestine world of financial misdeeds. Picture this: a world-renowned bank, its pristine facade shattered by revelations of unauthorized accounts, benchmark manipulations, and a clandestine dance with sanctioned nations. These are not the plot twists of a best-selling thriller, but the riveting narratives of real-life banking scandals that have left an indelible mark on the financial landscape. Join me as we unravel the gripping tales of financial transgressions, where power, money, and morality collide in a narrative that goes beyond the balance sheets to explore the darker side of the banking world. Welcome to the high-stakes drama of banking scandals, where truth is stranger than fiction. Wells Fargo fake account scandal, 2016.
Relentless pressure, unrealistic sales targets, a culture built on selling as many products to customers as possible.
The Wells Fargo fake account scandal of 2016 stands out as a stark reminder of the perils of prioritizing short-term gains over ethical conduct. Wells Fargo, one of the largest banks in the United States, faced severe backlash when it was revealed that thousands of its employees had opened millions of unauthorized accounts without the knowledge or consent of customers. The scandal illuminated the toxic culture within the bank that pressured employees to meet unrealistic sales targets, leading to unethical practices. The consequences were severe for Wells Fargo. Regulatory investigations were launched, resulting in the bank being fined a substantial amount. Additionally, the scandal had profound repercussions on the bank's reputation, leading to a loss of customer trust and confidence. In the aftermath, the CEO resigned, and the bank underwent a significant restructuring to address the systemic issues that allowed such practices to proliferate. The Wells Fargo scandal serves as a cautionary tale for the banking industry, highlighting the importance of fostering a corporate culture that values integrity and customer well-being over short-term financial gains. It underscored the need for robust internal controls, ethical leadership, and a commitment to transparency to prevent the recurrence of such egregious practices. LIBOR scandal. The LIBOR scandal, spanning the years 2008 to 2012, shook the foundations of the global financial system. The London interbank offered rate, LIBOR, a key benchmark interest rate, became the epicenter of a widespread manipulation scheme involving major banks, including Barclays and UBS. The scandal revealed a systemic flaw in the calculation and reporting of interest rates, with banks submitting false or misleading rates to manipulate the benchmark for their own financial gain. The consequences of the LIBOR scandal were profound. Numerous banks faced substantial fines, and regulatory actions were taken to address the vulnerabilities in financial benchmark systems. The scandal prompted a re-evaluation of the regulatory framework surrounding financial benchmarks, leading to reforms aimed at enhancing market integrity and preventing future manipulations. The LIBOR scandal underscores the importance of maintaining the integrity of financial benchmarks that serve as the foundation for various financial instruments. It exposed the need for enhanced regulatory oversight, improved transparency, and stricter enforcement mechanisms to ensure the accuracy and reliability of benchmark rates. BNP Paribas money laundering case, 2014. In 2014, BNP Paribas, a prominent French multinational bank, found itself entangled in a high-profile money laundering case. The bank faced allegations of violating US sanctions by facilitating transactions involving countries such as Sudan, Iran, and Cuba. BNP Paribas ultimately pleaded guilty and agreed to pay a record-breaking fine of $8.9 billion, reflecting the severity of the charges. The case highlighted the extraterritorial reach of US sanctions and the significant legal and financial consequences for banks that fail to adhere to international regulatory standards. BNP Paribas' involvement in facilitating transactions with sanctioned countries underscored the need for global financial institutions to implement robust due diligence processes and compliance mechanisms to prevent unwittingly becoming conduits for illicit financial activities. Standard Chartered money laundering allegations, 2012. Standard Chartered, a British multinational bank, faced allegations in 2012 of violating U.S. sanctions by facilitating transactions with Iran. The bank ultimately reached a settlement with U.S. regulators, agreeing to pay a fine of $667 million. The case shed light on the complexities faced by banks operating in a globalized financial system, where adherence to international sanctions is paramount to maintaining financial stability. The Standard Chartered case highlighted the challenges banks face in navigating the intricate web of international regulations and sanctions. It underscored the importance of developing and maintaining robust compliance programs capable of identifying and mitigating risks associated with international transactions. Moreover, the case prompted a reevaluation of the effectiveness of existing regulatory frameworks in preventing illicit financial activities on a global scale. Danske Bank money laundering scandal, 2017. The Danske Bank money laundering scandal, which unfolded in 2017, revealed a systemic failure in the bank's anti-money laundering (AML) controls. Billions of euros, primarily from Russia and former Soviet states, were funneled through Danske Bank's Estonian branch in a series of suspicious transactions. The scandal prompted intense regulatory scrutiny and resulted in significant leadership changes within the bank. Danske Bank's failure to detect and prevent money laundering underscored the critical importance of robust AML controls and due diligence procedures. The scandal highlighted the need for financial institutions to invest in sophisticated monitoring systems and ensure a strong culture of compliance. It also raised questions about the adequacy of regulatory oversight and the effectiveness of international efforts to combat money laundering in the banking sector. The banking scandals discussed above serve as cautionary tales, revealing the consequences of ethical lapses and inadequate regulatory oversight within the financial sector. These cases underscore the need for financial institutions to prioritize integrity, transparency, and customer welfare. Regulatory bodies play a crucial role in holding banks accountable for their actions, and ongoing efforts are needed to strengthen the regulatory frameworks that govern the global financial system. As the banking industry continues to evolve in the face of technological advancements and increasing globalization, it is imperative that lessons learned from past scandals inform future practices. Financial institutions must invest in robust internal controls, ethical leadership, and compliance programs to build and maintain trust with customers and regulators alike. Ultimately, fostering a culture of accountability and ethical conduct is not only a legal and regulatory imperative, but also essential for the long-term sustainability and reputation of the banking industry.